6 of the way our document is.
Of our agenda.
Of our agenda document. I'm not sure how that calibrates. You make the comment that the scheme first makes its first operating profit when water demand is approximately 72%. So basically that, what I'm reading is that line looks like it's about 72% or so. And that's accurate? Is my understanding accurate? That's the uptake level that can produce a steady operating profit.
It would be after depreciation though, wouldn't it? So it's different from cash flow.
Probably after meeting returns, I think.
Yeah.
I can't find that page, sorry, our reference page is different. Do you have...
What's the page here?
On ours it's 66.
So the page after that, the page after
47?
figure 15. Remember you had figure 15 up on the slide, up on the thing? The page after that.
Okay.
Oh yeah.
Okay.
Okay.
Yep, and whereabouts on that page, sorry?
In the top right corner.
Okay.
In fact, it is not until the financial year ended, blah, blah, blah.
Yeah, so I think Alan's right there. So what that refers to is the metric where we say first operating profit. So that would be operating profit before tax, but not cash flow from operations. So what that is effectively saying is, if we go back to that chart here, and I think it shows through in here is, hopefully you can see my mouse, but 2024. So effectively what you've got from a pure company structure is you've actually got a company that's making losses before tax, but positive cash flows. So losses from an accounting point of view after depreciation's going out, but positive cash flows. And
so I don't understand any of that, but all I'm looking at this,
well, depreciation.
There's a certain uptake that guarantees an operating profit.
Yeah, but
that appears to be 72%, and elsewhere in this document, you're pretty dismissive of the notion that that would ever be, in fact, the top, because you just don't think that ultimately farmers could resist the proposition.
Look, I think that's not quite true, but let's make a couple of points. Firstly, assets get depreciated, right? And this asset's depreciated over the life of 70 odd years or whatever it is. That depreciation is a non-cash item, and it's a big item, right? Because you paid for the item up front. So the cash flows available to the investors in the scheme, you have to add that depreciation back. And that's why when you look at that chart, you get a big difference between the operating cash flows and operating profit. So that's the first point, and it's pretty important because we're talking about big numbers here over the life of the scheme. Effectively, that depreciation repays that initial investment. So, but that cash flow is available to the investors. Secondly, not being dismissive. The point we're trying to make is that if you didn't sell that demand at a certain price, would you sit there passively, or would you try and figure out? You mightn't get to sort of nirvana where you've got 100% sold, but would you figure out different strategies to try and improve your revenue from a scenario where you sat with 75% sold and zero revenue off the balance? And we're not trying to speculate on that. We're just trying to say that ordinarily we would think that people behaving commercially would try and figure a way through to get a better outcome than just sitting there passively.
And I think the final point on that is, so as Alan said, those two metrics are quite different. So effectively your your cash flow from operations is your line in your cash flow statement, and the operating profit before tax is your line in your profit and loss statement. And the difference between those at 2024 is, you can see your point around break even from an operating profit before tax point is at 2024, but the actual cash flow available for investors that will go and be distributed to investors under that scenario is circa $20 million. So quite a different number between. And I think the other point to note is that this structure is the same with all investments of this nature. So a number of the cooperative schemes that are run in the South Island have a similar structure. So, and a lot of those operate at a break-even point of view from a cost perspective to obviously minimise the cost to the farmers, but that's because the farmers are the investors of the scheme at the same time. But a lot of them have accounting losses on the way through as well. And a similar structure would occur under a public-private partnership, again, where you've got large material accounting losses, which generate effectively tax losses which can be used by investors, but at the same time you have positive cash flows which are able to repay both debt and make distributions to investors. I think we're up to here. Yeah, so again, I mean, I think to the extent that this is presented in the report, and what we have in the report in Appendix 6 is we've actually put the narration alongside that, and I probably wouldn't spend much time on this slide because each one of these has its own narration, and what we've tried to do in Appendix 6 of the report is basically describe the nature and the manner in which the returns to both the project and the council behave under each one of these scenarios. And I think the only one to note here is there's an addition from when we presented last time in our interim report, which is under that extreme downside scenario, which is effectively capped at the 75% demand, and that's really demonstrating those returns. So you can see clearly under that scenario, a significant dip in returns through to the trigger date, and what that's really indicating is that there's negative cash flows up until that point. But then the point that I made before was that the repayment of the initial investment under that scenario would come after a period of 29 years, but over the entire period of the dual concession is a sort of a 5.3% return. So this one, in our report, again, it's going to have a different page reference, and apologies for page 73. Okay, there you go. So I think the key and overarching point of this, and for those at the back, and those that don't have a copy of the report, you're probably going to struggle to see the different colour lines. And apologies, that the shades are very similar here, but I think that there's two key points to make on this, and the report describes each of these scenarios in turn, and then it describes the way in which the returns behave under each of those scenarios. But I'll just draw your attention to scenario 1, which is effectively the base case, and that's this line that goes through here and has the dotted line just above it. So scenario 1 and scenario 2 are very similar, and what that scenario shows is from the point of investment at financial close, there's no point at which the council is called to put in more money. What an assumption has been used in the financial model, and it's described in the report, is that notionally, and this may change in the final structure, so hence we've indicated that we'll review that, notionally under the agreement with institutional investors and other investors, a portion of the repayment of CII will come from effectively the returns from council, and what that means is that money will be distributed from the to the council, and then effectively a portion of that would be paid back to repay CII. What that means is that's the same outcome as if you just had retained the money in the actual investment company and paid CII first and then paid the money out. So it's simply a modelling assumption that's been used. But what it's showing here is that after repaying CII through to a period after the trigger date, there's no period in that base case which effectively goes negative. What we do have is we've got two lines down the bottom that probably everyone's eyes are drawn to inevitably, which are two scenarios which show a period of negative cash flows where effectively the council would be called on to put more money on under these scenarios. But obviously, again, as we've always said, there's options which would potentially change that. So scenario 4, I'll draw your attention to, basically assumes that no bank debt would come into the structure at all. So what that would mean is the structure that's financed at day 1 would involve the council's contribution, a contribution from Crown Water, and then effectively only ever private money, so either institutional or from local investors, and no senior debt would be put into the mix. And under that scenario, there would be a point that in order to meet the repayment of the CII money, there would be some additional capital calls on the council under the base case up to a cumulative amount of $12 million. Now, the reality is we don't see that structure playing out, and again, in our final review, we'll make note about what the structure is and how it's been structured, and whether there's a level of bank debt in and what that number looks like. But certainly, there is an expectation, given you have a set of cash flows that will be relatively known at financial close, that you will have an ability to bring in some senior debt either at financial close or at a period after financial close, because those cash flows can be identified and bankers can get some comfort around carving up those cash flows. The other line, which is slightly above it and sort of slightly counterintuitive, is scenario 5, which dips down to a cumulative contribution from the council of $9 million. And what that is that's the same situation where you have no bank debt at all in the structure, but you have an extreme downside scenario. So that's where the uptake effectively drags on per our previous charts. And what you have there is, under the proposed structure with Crown Irrigation, you have a softening of your requirement to repay them, because effectively they're protecting or facilitating their repayments based on a demand profile, and if that demand is slower, then the repayments would be slower.
Question about that. You make that comment in a number of places that the repayment still is understood to be pegged to the cushioning the uptake process and so forth. But I thought I read in their public statements that they have a hard 10-year limit on the amount of money they would lend. Am I wrong about that? Or could someone else in the room clarify that? Because what you're assuming here is that this could be dragged out indefinitely, more or less, depending on the take-up.
I think that the point is that this one definitely does not drag on forever. So there is a point. What will happen under the structure that we've been provided with? And again, I think we'd come back to the point that our understanding is that Crown Water is last cab off the rank. So the structure and nature and format of their investment is subject to change up until the fact that every other person has put their money in. So that the final structure may look different to this, and therefore that's why we've indicated that we would come back and look at these sensitivities again under the final agreed shareholding structure. But what this assumes is there is a hard trigger date in the model, and I can't recall off the top of my head, but it's kind of in or around that period, the 2028 period, where you actually start just forcing repayment to CII. So regardless of what demand's done, you will start forcing repayment. And you will have to fund that either from greater contributions or potentially borrowing bank debt or other mechanisms. But there is a assumed hard trigger date in this model. But again, that could be subject to change.
And I think as David said, that the two scenarios that dip below the line assume no bank debt, but you're not looking at enormous quantities of cash that would need to be funded, and the cash flows at that point of time would be ample in our view to facilitate a portion of bank debt in the structure, which means that the decision HBRIC would be taking would be whether it prefers to put more of its own money in, or whether it prefers to have an element of the structure financed by bank debt.
Or there is an alternative structure, obviously, which is to offer a portion of the council's investment for sale. So be that to another investor, so an investor that's not already in the structure, or as typically would happen under any kind of capital call arrangement for any company, you effectively choose to be diluted. So other investors will take up the contributions that you're not willing to take up. So there's many and varied options available, not all of which would involve bank debt or any other sort of dire arrangements. You could continue to just dilute out to nothing, or to a very small shareholding. It would depend on each individual investor's view of what the future might look for the scheme.
Question. Mark, I'm interested in scenarios 4 and 5, lines 4 and 5. And the way I read them the other night was that they do involve a risk of debt against the council. And you've said in one it's 12 million likely, and the second is 9 million. But you've then gone on to sort of brush it all away and say, well, basically this wouldn't happen. But I think got some assumptions. Assumptions are that people looking at making those decisions at that time might react the way that we think they would today. That might not be the case. And I'm also mindful of the fact that we have a responsibility to explain to the public with a degree of reality of what the actual risks are. And I'm just give the analogy that I went to get an injection the other day. And the list were listed from death to blah, blah, blah. They're very clear about it, So I knew exactly what I was in for. But you do it, you with me? And I just don't think we can undersell the risk here. So I want you to come back to me and just say, is that it's either a risk to us or it's not. I don't want to have a risk, but it's either a risk or not. I want some clarity about that.
Okay, well, what we are saying is, under those scenarios, we believe the council would have legitimate options, which mean it would not have to put its own capital in.
Yeah, and I think, yeah.
Okay.
And so it wouldn't be forced to put money in. It would have choices to make, but it would have other options that would mean that it wouldn't have to put its own capital in.
But the point is, it could wind up with a bill of 12 million, but it has lots of options to get out of it.
That's right.
Yeah.
That's a clearer way of putting it.
Okay. Okay. So really, just to close off, but then I'm happy to take further questions. There is a context for this investment being, government treasury's commitment to irrigation more generally, and that's really links back to the comments we've made about Crown irrigation. Accepting that its final form, is still to be locked down, but that's why it's in the mix in the first place, and so why it is not unreasonable to assume to see public money of that nature in the capital structure. That mechanism was set up by government to help facilitate schemes in this space. That said, the RWSS, as we've touched on in the report, it is unusual in that environmental and economic development considerations are a major driver for the commitment of the scale of the public investment, as opposed to the typical cooperative funding structure. So this is a large scheme, and the amount of money being sought by investors generally, but from the Crown, is substantial relative to other schemes that we know a little bit about. But as we've said, the combination of objectives and the scale of the scheme means that subsidised capital is important, is really required to support the scheme through that initial period. But at full uptake, and this gets back to some of the comments that you folk have made, and the understandable and legitimate, that once you get you through that up to an uptake scenario that's settled, you do have an investment in a major piece of infrastructure that does generate strong cash flows, but clearly those cash flows are underwritten by the contractual commitments from the farmers. So effectively you go from the underlying model at the end of the day is a major piece of infrastructure that generates very strong cash flows, but standing behind those cash flows are farmers, and so it's clearly those cash flows fundamentally depend on the ability of farmers to stand behind those contracts, and that's obviously something that you'd expect to be sort of substantial value standing behind that commitment, but there are a number of outstanding matters that have a material influence on the financial viability of the project that are still to be locked down, and therefore it's likely that the business and related financial case that we've looked at to date will change and will probably need to be reviewed again once those matters have been locked down. But what we've tried to do is, I guess, demonstrate as well as we can what the major building blocks as they stand today are, and therefore where any subsequent review would need to focus to give final comfort or otherwise in terms of whether what's ultimately agreed to hangs together.